This is Nightly Business Report with Tyler Matheson and Susie Garrett. Funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
Two big moves by two of the world's most prominent central banks in Europe and China triggered a stock market rally across the globe and sent investors looking for new places to put their money. Two big events are happening next week that could determine whether oil prices continue to slide, and one big hearing where senators accuse the Federal Reserve Bank of New York of being too cozy with the banks it regulates. All that and more tonight on Nightly Business Report for Friday, November 21st. Good evening, everyone, and welcome. Susie has the night off. Well, the major averages just wrapped up their fifth week in a row of gains, and there were more record closing highs for the Dow and the S&P 500 today, thanks to major moves by two of the world's largest central banks. First, the People's Bank of China cut benchmark interest rates over there for the first time in more than 2 years, looking to combat slowing economic growth. Then, European Central Bank President Mario Draghi promised to use whatever means necessary, even buying up sovereign bonds, to boost that region's struggling economy. And with that, investors plowed into stocks in Asia, in Europe, and right here in the U.S. That sent major averages surging right out of the open before they lost a little bit of steam later in the session. Nevertheless, at the close, the Dow was up 91 points, record high there, closing above 17,800 for the first time. The Nasdaq up 11 and the S&P tallied a 10-point gain. For the week, with the Dow, it was up 1%, the Nasdaq up 0.5%, and the S&P up 1.1%. Steve Leisman has more now on the market-moving actions by some of the world's big central banks and what's next for our own Federal Reserve.
Central bank developments in Europe and China highlight not just the difference in economic weakness overseas and strength in the U.S., but also the increasing divergence in interest rate policies. While the European Central Bank considers greater quantitative easing, the Fed just ended its QE program. While the People's Bank of China cuts rates, there's wide agreement that the Fed's next move is to raise them. But the Fed is carefully watching these overseas moves. It even debated at its October meeting whether to say in its policy statement that foreign weakness raised the risks for the U.S. economy. But will it keep them from hiking?
If things fall hard enough in Europe, as an example, then yes, I think it actually could attenuate the cycle in the United States. But we're talking about a backdrop that would have to have deteriorated in a material way.
Others have already changed their view. Citi moved ahead its forecast for the first rate hike to December 2015 from September. And money manager Jack Ablin said foreign weakness and central bank easing is going to make the Fed wary about moving too quickly.
I think the Fed recognizes that the risk of tightening too soon and ending up back in the ditch is much harsher than waiting too long and having to fight perhaps growth or inflation down the line. I think they would rather err on the side of too much ease and then, ratchet back than to tighten too soon and then really run out of ammunition.
All that global easing, Ablin says, is good for equities, but there are challenges. The dollar has strengthened against the euro as investors come to believe the Fed will tighten, that is, raise rates, and the ECB will ease further. It's a challenge to U.S. exporters and pushes down on inflation by making foreign imports cheaper in the U.S. Most likely, the Fed will watch to see if these actions by other central banks help their economies grow. If they do, the Fed will stay the course and hike rates next summer. But if global weakness undermines the U.S. economy, and if deflation overseas washes up on these shores, then the Fed could well hold off and stay at zero for a bit longer. For Nightly Business Report, I'm Steve Leisman.
Tonight's Market Monitor joins us now to talk more about what Europe and China's central bank moves will mean for the U.S., as well as his stock picks. He's Eric Ristabin, Chief Investment Strategist with Russell Investments. Eric, good as always to have you here. Do you think what China is doing and what Mario Draghi proposes to do are the tonics that those two economies need to get them moving in the direction that the central banks seem to want them to?
Yeah, ultimately, yes, we think these are going to be successful moves. I mean, in China's case, I mean, they're obviously intentionally slowing their economy, but more specifically, they're trying to adjust the composition of their economy. They're trying to slow the investment part on housing principally, while actually making sure that the other part of their economy, particularly the consumption part of the economy, grows. Lowering interest rates internally within the country help. Probably also help making their currency a little bit cheaper versus the yen. In Europe, Draghi is really continuing to communicate with maybe a little more urgency that he's worried that the inflation rate is too low. So he's talking about doing as much as he can, as fast as he can, to raise inflation and to raise inflationary expectations. This is in addition to the $1 trillion almost of euro stimulus that he's already started to put in the system in this summer and the fall. We think ultimately those will be successful in raising the inflation expectation and therefore the growth rate in Europe.
Is Draghi really walking the walk in addition to talking the talk? It sounds like there's a lot of wind-up and not as much pitch here.
Yeah, certainly. Yeah, he's been winding up for quite some time on this. Look, he's got a very difficult political process. He's got to effectively bring the Germans along. The Germans will point out there's a legality issue as it relates to full-blown quantitative easing, where the ECB would buy sovereign debt. He's trying to create the conditions so that the necessity to do QE kind of, is the mother of invention in terms of actually being able to get the Germans to implement it. If he needs to get there, I think he's actually going to be successful. It's not clear he's going to have to go to full-blown quantitative easing, however.
Let's move on to a couple of your stock picks. And I know that you see the U.S. as kind of, as Keith Jackson used to say, the bell cow of the global economy. Let's start with your reasoning behind financials. You like PNC, and your second one is also a financial. Why are you high on it and financials generally?
Yeah, well, financials, and specifically within financials, banks. Look, we think the U.S. economy is continuing to expand. We think employment is such, and the economic activity that we've seen in the improvement in employment and economic activity is going to continue to cause greater and greater loan demand. We're really basically looking at banks as kind of a fundamental play in terms of we think their earnings are going to be accretive because there's going to be more loan activity because of a better economy. And Citibank in particular is cheap.
And Citibank is your second choice there, and it is relatively low priced, but it's kind of low priced for a reason, isn't it, Eric?
Yeah, well, yeah, it has lots of reasons why its price historically has been low. Those reasons are beginning to fade into history, and really we think that actually their business, their ongoing operating business will be enough to drive value. PNC is one of those super regionals that's just been well positioned throughout the entire cycle. A little more expensive, but frankly, probably a safer bet in terms of future performance.
Let's move on to your third choice, which is Live People. I'm not familiar with it. Tell me about it.
Yeah, LivePerson it's actually an interactive client engagement. They sell software. So if you've ever been on a website and a little bubble comes up and says, "Do you need some help?" You haven't done anything in a while. Or, do you have a question for me? That's probably using the LivePerson software. We think they're well positioned within the segment. We like software in general, but particularly we like them because they're well positioned. The other thing is their potential takeover target, and finally, they should be able to benefit from what we think is going to be a continuation of increasing CapEx expenditures, and particularly in technology, and they're kind of in the sweet spot in our mind for that.
Eric, thank you so much. We appreciate you being with us. Have a great weekend.
You too.
Eric Ristobin with Russell Investments. Well, today's efforts to boost the economies in China and Europe also lifted the price of crude oil. West Texas Intermediate settled 66 cents higher at $76.51 a barrel. Benchmark Brent crude rose more than $1. It closed at $80.36 a barrel, wrapping up its biggest weekly gain since all the way back in June. Now, even though oil prices have tumbled 30% since their summer peaks, a couple of events coming up this week, or next week really, could really rattle the oil markets and oil prices. Our Jackie DeAngelis has the details.
The free fall in oil, contained for the time being, but next week could be a game changer. Monday is the self-imposed deadline for talks over Iran's nuclear program. Traders eyeing the date as a potential catalyst because it could open the door for sanctions on Iran to be lifted, which would flood the market with Iranian oil. If that were to happen, prices could fall further from here.
If Iranian oil comes back onto the market, conventional wisdom does say that we will work our way lower.
And Thursday, Thanksgiving in the U.S., but a highly anticipated OPEC meeting in Vienna. Up till now, expectations were that OPEC would not announce any production cuts. But sentiment is shifting, and there is talk in the market that OPEC might reduce output by 500,000 barrels per day to boost prices, or at least stem steeper declines.
While the consensus seems to be that OPEC will not cut production Thursday, I'd be very surprised if they didn't.
If OPEC were to reduce its output, 500,000 barrels per day isn't that significant when you consider that the cartel's production is 30 million barrels per day. However, it does indicate that certain members like Venezuela are starting to pressure the Middle Eastern members to cut prices before they fall too far, too fast. Right now, it seems the market is in a wait-and-see mode. Traders not wanting to position themselves ahead of these big events, but next week could be key in determining oil's price direction for the foreseeable future. For Nightly Business Report, I'm Jackie DeAngelis.
On to Washington now, and day 2 of Senate hearings over allegations that some of Wall Street's biggest investment banks manipulated prices and unfairly traded commodities like aluminum. Federal Reserve Governor Daniel Tarullo, the central bank's point person for bank regulation, said the Fed would broaden its review of gaps in oversight of physical commodity operations in the U.S.
One of the things that we have been thinking about in general, although now specifically in the commodities context as well, is how to assure that there are robust enforcement and compliance mechanisms within firms.
In written testimony, Tarullo also promised new Fed rules overseeing commodities trading by banks in the first quarter of next year. At a separate Senate hearing, lawmakers blasted the president of the New York Federal Reserve Bank as they probe whether regulators are too close to the institutions they're supposed to be overseeing. Hampton Pearson reports from Washington.
No Republicans showed up for a Senate hearing focused on the Fed's oversight of Wall Street's biggest banks, but that didn't stop Democrats from putting New York Fed President William Dudley on the hot seat.
Are you holding up a mirror to your own behavior when you say that no one should question your motives or what you're trying to accomplish?
The culture starts at the top, and the perception is that you essentially were hired by the people you're regulating. I think that cultural message permeates throughout the entire organization.
I think the bank culture needs to be improved significantly. I think there's a number of things that we can do in that space to improve incentives to get the behavior that we absolutely require from the banking industry.
At the heart of the latest firestorm, allegations the Federal Reserve Bank of New York went easy on Goldman Sachs in reviewing a deal Goldman was pursuing with a Spanish bank. Adding drama to the day, former Fed employee Carmen Segarra sat as a spectator in the hearing room. Ms. Segarra, who's engaged in a lawsuit over her dismissal from the Fed, came into the media spotlight when she released secret recordings of Fed meetings that appear to show the central bank as a lax regulator.
We've got on tape higher-ups at the New York Fed calling off the regulators.
There are 46 hours of tapes. There was about 10 minutes of those tapes that were released.
The New York Fed president denied the central bank has serious cultural problems, but he did say it can always improve how it oversees the nation's biggest banks. For Nightly Business Report, I'm Hampton Pearson.
Also in Washington, harsh words from Speaker of the House John Boehner one day after President Obama announced he was extending protections against deportation for upwards of 5 million undocumented immigrants currently in the U.S.
With this action, the president has chosen to deliberately sabotage any chance of enacting bipartisan reforms that he claims to seek. And as I told the president yesterday, he's damaging the presidency itself.
In response to the president's executive order, Boehner says Republicans are considering filing a lawsuit or may try to block funding for the president's policies or may even pass immigration measures of their own. And House Republicans did file a lawsuit today, this one trying to scuttle the president's signature legislation, the Affordable Care Act. The suit cites the Act's administrator, the Health and Human Services Department, and the Treasury for delaying implementation of the employer mandate, which was supposed to go into effect this year, as well as for the $175 billion in funding that's been given to insurance companies to subsidize health care enrollees. Still ahead, will this early winter turn into a business boom for the ski industry? We'll hit the slopes next. A new stock began trading on the NASDAQ today. It's Peak Resorts. It operates 13 ski resorts in the Northeast and Midwest, including Mount Snow up in Vermont and Snow Creek in Missouri. Now, after pricing at $9 a share last night, things did go downhill pretty fast. Shares, which trade under the ticker symbol SKIS, clever, end their first day of trading down 5.5%. Well, if that's got you thinking about hitting the slopes, you are in luck because the ski season officially opened for business nationwide today. So what can the industry expect this winter? Our Morgan Brennan has more from Hunter Mountain in upstate New York.
It's that time of year again, the start of ski season. Thanks to the cold snap stretching across so much of the country, ski resorts are kicking off their seasons earlier than usual. At New York's Hunter Mountain, the slopes officially opened today, before Thanksgiving for the first time in 5 years. And conditions in the Rocky Mountain West have operators optimistic about business.
We've got tremendous natural snow here in Colorado and have had for the last couple of weeks. And we're looking at more snow for Tahoe, for Utah, and here, all for the next week.
Weather is the single biggest factor for ski resorts, the reason profits have shrunk for some companies despite higher ticket prices. Companies have been investing in more snow guns to minimize the impact of volatile weather. But making snow is a costly process, and it requires water. The National Ski Areas Association says visitor numbers modestly declined last year to 56.5 million, thanks largely to the lack of precipitation in the Pacific West. The ongoing drought in California could further that trend this year. But analysts say companies like Vail and IntraWest Resorts are finding creative ways to lure customers. For example, pushing season passes before winter begins.
That is really the big trend, is get people to commit to skiing earlier in the season. And effectively, once you lock them in, they're more likely to ski a number of incremental days throughout the season. So it's really a move to get people to book earlier, and ultimately they'll ski more often.
And spend more. Last winter, Americans spent a record $3.6 billion on ski equipment, apparel, and accessories. And Snow Sports Industries Americas projects similar sales this season.
But whatever this winter brings, one thing is certain, and that's the ski industry remains healthy. And on days like this, it's easy to see why. For Nightly Business Report, I'm Morgan Brennan in Hunter, New York.
Well, Dow Chemical dodged a bullet, settling a debate with an activist, and that is where we begin tonight's market focus. The specialty chemicals maker has agreed to add 4 new members to its board of directors after pressure from Dan Loeb's Third Point hedge fund, and it avoids a proxy battle in so doing. Also, Dow and Third Point have entered a standstill agreement, meaning that Third Point will not publicly criticize the firm for 1 year. Shares of Dow popped more than 2.5% to close today at 52.84. Loeb also came out on top in his fight with Sotheby's. The CEO of the auction house will step down now by mutual agreement with the company's board, but he will remain in the job until a successor is found. This after the activist Dan Loeb and others joined Sotheby's board. Shares were almost 7% higher. They closed today at 41.93. Foot Locker's third quarter sales and earnings stepped past Wall Street consensus, but investors didn't seem too impressed. The CEO of the athletic gear company is stepping down on December 1, and that could be what's rattling investors since the transition comes during the holiday shopping season. Shares fell more than 4%. They closed at 54.55. Ann Incorporated, that's the parent of Ann Taylor, posted sales that missed estimates and warned that it would log its first comparable store sales decline in 10 quarters. Its earnings did manage, however, to top estimates. The company partly blamed product shipment delays out of West Coast ports for its weak sales. Shares fell slightly to 38.23. And Aetna is hiking its quarterly dividend. The payout will be 11% higher, up to 25 cents a share now. The insurer is also setting aside an additional $1 billion to buy back shares. Shares up more than 50 cents today to 86.36. And still ahead, we all know Apple and Google got their start in a garage, but where does the story of Alibaba begin? We'll take you there, all the way to Hangzhou, China. Walmart is gearing up for big crowds of shoppers on Black Friday and for protesters, too. Labor organizers and Walmart workers unhappy about low pay, poor working conditions, and little chance to achieve a full-time job are planning protests at 1,600 stores across the country next Friday. That's, of course, one of the busiest shopping days of the year. And finally tonight, a look at the small apartment in the Chinese city of Hangzhou, where Alibaba, now one of the world's biggest companies, was born. And surprisingly, 15 years later, Jack Ma's modest flat is still being used to foster inspiration by the company's programmers and product developers, hoping to make the e-commerce giant even gianter. David Faber has more now from Hangzhou.
If the garage is the sacred spot where so many of America's great technology companies were born, in China, it is this one place, Building 16-1 Lakeside Gardens, Hangzhou, China. It's the apartment where Jack Ma lived with his wife when he started Alibaba in 1999. Unlike its predecessors in the States, this is no shrine, but an active office where Jack Ma sends his most promising developers and programmers to find inspiration. Ma's apartment sits just through this gate, off this busy Hangzhou street, a few miles from the 54-acre Alibaba headquarters that's home to 14,000 employees. The campus has all the accoutrements of an American tech company: the gym, the foosball and pool tables, and a state-of-the-art television studio. But given the option of working there, on campus, with all of its trappings, the top-level programmers are happy to be here. In this 6-room, modestly decorated, and dare I say, crowded apartment, where Ma lived 15 years ago. Do people like working here in the apartment? It's not, the headquarters is very nice. Got a gym, you can play ping pong, pool. There's nothing here.
I think it's enough. It's enough for all the people.
Chen Hong is a product manager for Alibaba. So when you are starting a new product at Alibaba that's important, people come here to get what we call inspiration, to feel the power.
Yes.
He and his team will spend about 10 months here, working 13 hours a day, 7 days a week, eating, napping, working, and channeling their inner Jack Ma. Must be important.
Yes, important project.
Important indeed. Tmall, Alipay, and Taobao were all developed here. It's no wonder Jack Ma keeps sending them back. Yes. Biggest parts of the company were created here.
Started from here.
Wow. No wonder. It's got power.
Yes. And Chinese word is feng shui. Maybe
feng shui,
right. Feng shui is good.
It's very good here.
Yeah.
Okay. Maybe I'll stay. Jack Ma doesn't show up all that often, but there is a message on the wall, handwritten by Ma in 2008. It roughly translates to this: the core of this company is to grow and grow.
Good feng shui there. David Faber reporting for us from Hangzhou, China. Well, that is Nightly Business Report for tonight. Thanks so much for watching. I'm Tyler Mathisen. Susie will be back on Monday. Have a great weekend, everybody. We'll hope to see you here next week.
Nightly Business Report has been funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
I'm Tyler Mathisen with a Nightly Business Report news brief. Stocks rallied today with the major averages notching gains for the 5th week in a row following a surprise interest rate cut by the Central Bank of China and promises from European bank officials to do whatever's necessary to lift the struggling economies over there. With that, investors globally plowed into stocks. The Dow was up 91 points, new all-time high there. The Nasdaq up 11, and the S&P added 10 points. It also ended at a new record. Ski season officially opened today, but shares of the ski resort operator Peak Resorts ended 5% lower in their trading debut. And House Republicans filed suit against the Obama administration to try and stop parts of the Affordable Care Act's health care mandate. And tune in to Nightly Business Report here on your public television station.